Another risk to the stock market besides increased geopolitical tensions in the Middle East is the dock worker strike. This is the first strike since 1977 and could cost the economy up to $5 billion a day and could raise prices for the American consumer and cause inflation. The dock workers are doing this because they want a pay increase and they also are trying to fight automation, but this could increase inflation again. So this could be a little bit of a headwind and risk to the markets as well. I think geopolitics right now will probably take first center stage, but this is something we have to monitor too. Because if this goes on, that's $5 billion a day that it could cost the economy and raising prices on many goods that we're importing, as well as some of our exports. So this is something we have to watch. I still think from yesterday with Iran's attack on Israel, sending missiles, I think the market sold off on that. I think the worst is over in the short term in that regard. The next risk is what will happen next. What will Israel do? But until then, I think the worst is over in the market for the short term. But as I said last week, the market will probably trade sideways and be a little bit volatile until we have more answers on Israel's next steps, as well as what's going to happen with this dock worker strike, if that's going to be resolved, and the certainty and clarity of the election in just over a month. Once those three things are resolved, I think the market will charge much higher into year end. Most likely, I think the S&P 500 will hit about 6,000. Obviously, we have to see, but there's so many strong catalysts for the economy. Inflation's going down, and economic growth is still resilient. This reminds me of the 1995 soft landing scenario with a good backdrop of innovation and technology. So I expect a melt-up scenario in Q4 if the geopolitical tensions, the dock worker strike, and once the presidential election is behind us. Let's stay tuned.